Hi, everyone, and welcome to Everything About Wealth, the podcast. This podcast is focused on wealth building, and I'm your host, Denny Troncoso. This is episode number 10. If you were with us on our last podcast, episode number 9, Desi and I interviewed economist Dr. Joshua Harris. It is a great episode to understand our financial system and learn if a recession is coming. So make sure to check it out. In this episode, Desi and I will go over wealth building for retirement. We share a lot of tips, so make sure to take notes. Now, if you don't already, make sure to follow us on Instagram and Facebook at Everything About Wealth. Hey, Desi.
Hey, Denny.
How are you?
Good. How are you?
Good. How's everything going?
Going really good.
Very good. Very good.
One thing you forgot to mention is for people to check out our website at everythingaboutwealth.com.
Oh, yeah.
We have some fun resources on there.
Okay. Well, thanks for the reminder. I always forget something, right? I'm glad I keep you around. So how's everything going over here in the Orlando area? Rocking and rolling?
Rocking and rolling with a little bit of rain.
Oh, yeah. It's been raining a little bit lately.
Yeah, so if you hear some noise in the background, it might be because of the rain. But everything else is going good. I mean, the hot market is still hot.
Oh.
People are still buying apartments, houses.
Everything.
Townhomes.
Market is hot. The builders are building.
Yeah, exactly. So.
Good. Well, today we're going to be talking about what?
We're going to be talking about wealth planning.
Wealth planning. So we're going to be going over some tips on wealth building and planning out your retirement and answering questions like, how much money do I need to retire and what should I do to build that retirement and more?
Exactly.
All right. Well, let's go. Let's hit it.
All right. So, one of the first things I think we can get into in regards to wealth planning for retirement is, of course, set a goal. Is one of the first things you need to do with anything, right? So, you want to tell us a little bit more about what type of questions we should ask ourselves when we're trying to build a plan for our retirement.
Mm-hmm. Yep. So, some of the questions are... what lifestyle do I want to live in retirement? That's number one. And then based on that lifestyle, how much will I need to live that lifestyle in retirement? And what comes up with the lifestyle is when you retire, where do you see yourself living? Where do you see yourself driving? How many vacations do you see yourself taking on an annual basis? A good example would be maybe you want to take 4 vacations a year, and to be able to do that and live where you want to live and drive the car you want to drive, etc., then you need to have $15 million. That would be the best scenario for you to live that lifestyle. But then you may have a lifestyle that's in between. That's maybe instead of driving a Ferrari, let's say, or maybe you're driving a Mercedes, and then you're like, you know what? I could really do okay. It'll be okay if I have $10 million. And then in the worst case scenario, which is still a good retirement for you, you may say, you know what? But I still my bottom goal, the lowest I want to accomplish is $5 million, and then that'll still be in the range.
Okay, yeah, that completely makes sense.
Good.
Because sometimes I think we just try to figure out, we know we need to save for retirement, but I don't think we really go into thinking what type of lifestyle do I want to live when I retire. So
I mean, and the money is really going to give you the lifestyle. It's the most important thing. So you have to make sure that when you're choosing your retirement, the money is going to generate the lifestyle that you want. So first start with the lifestyle, then the money.
Okay. I think I just want to own a bike when I retire.
Okay. I mean, that's definitely possible.
Have you read that article about that lady? She lived till she was 120 years old, and it was because she used to ride a bike around the city.
Hey, I mean, I think we should still ride a bike. I mean, I don't know about just having enough funds for just the bike, but I think we should have for more than that. And then, of course, these were examples regarding the Mercedes and the Ferrari. driving a Toyota and having $15 million net worth is perfectly fine. Okay, it's for especially if you're going to be whatever you're focused on. Maybe it's traveling, or maybe it's something completely different. So let's continue with that. And then let's say the lifestyle goal is $10 million, to use a round number. And that the lifestyle you want to live, you need, let's use math, 4%, 10% would be $1 million. 4% of that would be $400,000 a year. And then in a lot of the big cities in this country, you have to be middle class. You got to be making $350,000 a year. I saw an article recently.
Right. Yeah. It really depends on where you're living.
Yeah. So maybe you can adjust that, evaluate your particular area. Maybe if you're living in Los Angeles, in New York, you really need to have $10 million to be able to be middle class in that city. But maybe you live in a different area where the cost of living is not so high. Maybe you only need $250,000 income. Maybe you have $150,000. But you also have to take into account that things are going to get more expensive, inflation.
Right, inflation going into the future. I also think another important point to make is also the age as well, and how much money you're going to not only need for retirement, but to live a certain amount of lifetime, because over the years, our lifespans are increasing.
Exactly.
Compared to what it was before. So I think that's also something to consider, is maybe even go a little bit further out than what you think. Because I know some people are like, oh, I'll save maybe to 75 and 80. But in reality, some of us are living into 90, 100 because of the advances that we have in technology and medicine and everything like that.
I'm going to be living until I'm 150. I'll take it. So with the advances in medicine, that's a great point, Desi.
So you need to save more is basically what my point is going to. You really need to consider a longer lifespan and how much more money it's going to take for you to live longer. Is where I was going.
Well, I'll take it a step further. You could do this two ways with the retirement. And then depending on the way that you choose, you may or may not need to accumulate as much money. All right. So if you follow the 4% withdrawal rate rule, what that does, it says that you shouldn't run out of money, that you should be earning at least a 4% return on your money or higher. And then if you're just withdrawing 4%, your money will never be, you never take out all of your money, right? So you can live off of that. The other thing that you could do is you can say, if let's say maybe you didn't accumulate enough money to live the lifestyle that you want, you really needed $10 million, but you only have 7, let's say. Maybe you can do a 6% withdrawal rate, but know that it's only going to last you maybe 30 years at an average rate. So then you need to take into account what's your lifespan with that, right? So you can plan accordingly.
Great point. So the next question I guess we can get into is one of the more important ones, is what are some ways that people can start building their wealth for retirement, which means is it through a portfolio? Is it through passive income? What are some ideas that people can utilize, or should I say investments to utilize, for us to be able to have that 10 million or 5 million that you're speaking about?
That's a great question. So there's many ways to generate wealth so you can retire. And there's many traditional ways. One of the first ones is like the stock market, right? And then there's other ways like real estate and businesses and so much more. And then I'm going to really focus on the top 3 because those are the ones that I really know, and that I know people that have generated wealth with that, and that's something that we also focus on investing in. But before I even tell you which one to focus on, I will say that your experience in that investing niche or investing focus is going to be very important for your comfort level, because your comfort level is the most important thing. There could be investments out there that generate 100% return, and for you and for probably me, they're very risky. But for someone else that's used to investing in that, their comfort level is very high because they have that experience. And then the other thing, other than experience, after experience, it's education. So also focus on what type of education you've gotten in investing, because that's also going to dictate what your comfort level is. And with that, I'll say that the stock market is a great area to build wealth. And there's so many different types of things you can invest in the stock market. I won't specify which one to focus on, but there's ETFs, which is exchange traded funds. There's index funds, and then there's mutual funds. And these are all things that you should consider investing in. But as the famous author David Bach said in the book The Automatic Millionaire, choose an area where you want to invest in and do it automatically. So put it on and every month it's going to come out of your bank account, or every week, however you're going to do it.
Can you tell us a little bit more about each one so we understand, like, what is a mutual fund, index fund, ETF, and how they may work differently?
So I don't want to dig too deep in the funds, but I will say with a mutual fund, it's basically it's a basket of stocks. It's managed professionally by a professional money manager. So there's you have an expert technically, and what they're focused on is they're focusing on keeping the portfolio balanced. Maybe 100 companies in there. You may have Best Buy, you may have Amazon, you may have General Electric, all within one fund. So they call it you're really diversified in some of these funds, just in case one company goes out of business, you don't lose all your money. Right. The next one is index funds, and index funds is a great one because it's not professionally managed, but what it does is it follows a similar concept like a mutual fund, where it's just evenly allocated. So that maybe the index may be the S&P 500, the Standard & Poor's 500. So there'll be 500 stocks, and then your money will be divided on these 500 companies. But what the fund does, it just follows the index. So it just follows whatever the index is doing, it just follows it. And then however many stocks are in there of that index, it just follows it. And what that does, it keeps the cost lower compared to mutual funds, which is able to save you money as an investor. And the cost for index funds, I think they're like 0.25% expense ratios, which are significantly lower. ETFs are not my expertise, but I know that they've gotten very popular, and they've gotten they actually have some benefits that are better than mutual funds. So that's something that we could probably talk about in another podcast.
Okay. So I know we just talked about stock market. I know one of our favorite ones, also to include in that, is real estate.
I think that's where your energy comes out.
Yeah. That's what I know more about.
Yeah.
I know with investing, if you follow the podcast or if you're an investor already, everyone's familiar with what real estate is. You have residential that comes more in the hand of homes and flipping, wholesaling. Those are different investment strategies that people are using. More of, you get a lot of cash at once, but it's not passive income. You definitely are more involved. Rentals. Yep. Well, you can do single family rentals. That's correct. That's what we did. And then we have more of the commercial, which is the retails, the industrial warehouses, multifamily, of course, and etc. That are good investments that you can hold long term.
Yep.
The other good way to invest for the long term is you purchase a multifamily, and then once you sell it, you do your 1031 exchange into the next property. So those are some tax benefits that you can take with you into the future, which are tax-free, of course, until you get that one property that you may have to pay taxes on because you get stuck with it, right?
Yeah. I think the 1031 is a great point. The 1031 exchange is something where you buy a property, you have a profit. Let's say maybe it's $100,000, $100,000 in profit. Instead of paying the taxes to the government, you decide to do a 1031 exchange to move into another property that you want to buy, and you can defer the tax. So one day you're gonna have to pay the taxes unless you die, right? Which that also happens. Sometimes people plan that out into their estate planning. But most of the time, you'll sell the property one day and then you'll pay the tax then. But the benefit is you bought a lot of properties in that process, and you were able to buy bigger properties because you didn't have to pay as much taxes. So.
Yeah. And I remember I heard from, I was reading a book. I can't remember if it was a book or an article, but it was basically an investor that spoke about how what an investment strategy you can use is that you buy multifamily, you sell, and then at the very end, once you've accumulated so much income or wealth, you can actually keep one. And then you keep that one basically for the duration of until you retire, so that you can have that cash flow coming in during that time. So I thought that was an interesting investment strategy.
That is a very good strategy, right? And then maybe that one property is hopefully you started maybe with a house, right? And then you grew it into maybe a duplex, a quadplex, 10 units, 50, 100, maybe 200 or more. So that's very possible. So the next one is, so we talked about residential, we talked about commercial real estate. There's different ways to do that. You could use it on a short-term basis to build cash, like Desiree said, or you could do it for rentals to build passive income. You either see what works for you. Then the next one is business ownership. And business ownership, you can accomplish it a couple of ways. You can either start a business, which if you're young or older, it's very possible to start a business. There's a lot of resources that can help you start a business, like the National Entrepreneurship Center in your area. There's something called an organization called SCORE, which has mentors that they can mentor you for free. All you have to do is you take like one of their classes, which is like $50. And then you can sit down with a professional that's in the business, that's making things happen now, and they can give you advice on your business. There's so many areas that they specialize in. And this is just some free services, so something to take advantage of. And then, I think about a quote because sometimes people say, I'm in my 40s. All these young whippersnappers are the ones that are starting the businesses, right? Mark Zuckerberg said one time, he said, the people in their early 20s are starting businesses because they're just smarter. But actually, there's a book called Range by David Epstein, and he said he saw that the data says something completely different, that the average founder is actually around age 45 because they've been in the field and they've learned what the opportunities are. So that's something to also consider.
And I think that's a great point. And I actually like business because people can use business into their real estate, which we've seen. So we've seen where a business owner, he makes quite a bit of money, and to offset some of his taxes, he actually buys real estate. But it also allows him to have another investment strategy, which he is diversifying his funds also into real estate that he owns in his business, so he's not just keeping all this cash on hand. And that's worked very well for him as well. So I actually think those two can really go together too, in building that wealth plan or your retirement in the future as well.
Yeah, that's a great point. There was a book that mentioned, I forget which one it was, I think it was the Robert Kiyosaki's The Real Book of Real Estate, and then they talk about how have your business buy your real estate, and then that's a great way to build wealth. So there's
he talks about a few businesses he tried to start, like there's a shoelace one, wasn't it? A key while you run in the shoe.
Oh yeah,
and then someone came and basically just outrun him because they manufactured faster than he did.
Yeah, that was his first business, which he was really smart in starting, a great idea, but he didn't do a lot of the things to protect it. So a lot of great stuff in his book, so definitely check it out.
Yeah. Great. Well, those are some of the ways. There are only 3. There's a lot of different ways you can do it, but I think those are the top ways that we've really seen people, the ones that, of course, that we're actually using ourselves as well. So what's another way do you think? I know we understand the investments and trying to start as early as you can to get into that. Is there another way that you will be able to build more of your wealth? Yeah,
so I don't like to be there's bean counters out there where it's the accountants that they're always focused on cutting costs. That's the way, we need to cut expenses to grow the business. So I really wanted to focus on number 1, We really need to grow income, which is building wealth by investing. And then that's going to help us achieve our goals of the lifestyle goals, the cash flow, the retirement goals. But really, another thing that's going to help you to get to retirement and to live the lifestyle you want is paying down debt. And there's several expenses that are several debts that we accumulate, from student loans to credit cards. But one of the biggest expenses is actually also our mortgage.
Dun, dun, dun.
Dun. And this one, it's actually, there's some really good arguments for paying off your mortgage early or save on interest. But then there's also some arguments not to, and I'm going to share that today. But let's start with debt stacking. Let's talk about that. Why is that so powerful when you're working with credit cards? And if you haven't heard about this, and you could try to find a software online that may help you with this, or maybe if you have a financial advisor could help you with this, or planner. But basically, it's when you focus on paying your highest interest credit card with your lowest balance, and you pay the minimum payments on the other cards, and you focus on paying that one card as much as you can on a monthly basis until that card is paid off. And then you snowball it the same amount you were paying. So let's say it was $500. Now you send the $500 to the next card plus the minimum payment that you were paying. So the goal is to, let's say if you have 2-3 cards, you can start really knocking them out. And then really after that, unless you really need the cards maybe to have it as a backup for investing, you probably need to cancel them, right? Maybe keep 1 or 2.
Yeah.
So, but the key is not to get into any more debt, right? So prevent you from getting into more debt.
Right, or you can use credit cards, but as long as they're paid off monthly, to maintain your credit score, which is a great way.
Yeah, no, definitely. I mean,
That's what we do.
Yeah, I think you can use your credit cards, pay it off monthly. I believe that 100%. I just think, some people, they pay off their cards, they work so hard to do it, but then they went right back into debt. So it's just, definitely you have to be careful with that. So cut the cards if you can't control yourself, right?
Yep,
if the temptation gets you. So let's talk about the mortgage, right? And there's some really cool things of paying off your mortgage early. You could opt for a 15-year loan instead of a 30-year loan. The 30-year loan is the standard loan in the United States, where it basically is going to be paid off within 30 years. It starts off with a lot of interest, and then it goes on to pay a lot of principal at the end of the loan. You have a 15-year loan, which is it's more balanced, so you're going to be paying less interest in the beginning because it's a shorter loan. There's also something that's very cool. It's called it's a home equity line of credit program where there's some software involved, but basically it's something that's very popular in Australia, where you can pay off your mortgage within 5 to 7 years, definitely under 10 years. This is something that it depends on what your equity is on the property. And then there's some formulas in there where you use your line of credit. It's a little complex, I think further than this phone call, this podcast episode. But it's something for you to look at because it could be realistic for you. And this is something that in Australia, it's very popular to pay your mortgage off early. Now, something that I really want to share is also in the United States, there's a bi-weekly loan program, and they're pushing to pay off your loan. A lot of experts recommend paying it off sooner. Bi-weekly loan programs, you could pay them off as low as 22 years, but the pretty standard I've seen is 25 years. And what you're basically doing is you're making an extra payment per year on your mortgage because you're making you're paying every 2 weeks, so there's an extra month basically that you pay in that process. So 26 2 weeks in a year. Now, I'll give you an example. If there was a loan, it was a 30-year loan, the loan was $200,000, the interest rate was 4%, and you decided to go with the biweekly loan program, you would pay over that time a certain amount of money in interest, but you would save $22,553 with the biweekly loan program instead of being in the 30-year loan program, right? So you save $22,500, which is great, right? You put that money in your pocket. But now, let's say within that same amount of time, 25 years, you said, you know what? Instead of making $80 a month, which is what you're doing, extra to my mortgage every single month, I'm going to go ahead and I'm going to invest this money in a fund or in an account, whatever, in an investment that's going to generate a return of about 12%. Let's say you find an investment of about 12%. A little bit aggressive, but not unrealistic. If you are an active investor, you do this for 25 years. At the end of that period, you're going to have $136,256. The difference is $113,000. What I'm basically telling you is that I would opt, me personally, to not pay the loan off bi-weekly and instead go ahead and put the money in an investment account to generate that 12% because it's going to generate more money for me over the long term. Now, this doesn't happen in every situation like this, so every situation is different. You need to look at the numbers. And there's some calculators that we're actually going to share that I found online, and they're free, that I'm going to share so you can, in our podcast episode summary review, as a resource where you can go and do the calculations yourself and evaluate your particular situation. Now, some people may say, you know what, I want to pay my mortgage off early. I don't care really about the money. I just want to have peace of mind. Look, if you want to have peace of mind, pay your mortgage off early. But if you are really focused on the return on the funds, this is a way for you to make an extra $113,000 that you wouldn't have made within that certain amount of time. I know it's a little technical, but we'll have that example too in the episode summary. Desiree?
Very good.
All right. So now one thing I'll say, and just kind of closing up here, I mentioned David Bach says invest automatically. If you're starting a business, you're buying a business, or you're investing in real estate, maybe you can't do that automatically. But set a schedule, right? Set a schedule to consistently invest. Maybe every week you're spending 5 hours, right, to your investment business, to your investment focus. The average investor, according to the book The Millionaire Mind or The Millionaire Next Door, I'm not sure which one it was, is that the average millionaire spends about 20 hours a month focused on their investments. So just a realistic thing that you should probably do the same, right, if you want to generate the same results.
Yeah, very good point. Stay active, stay current with the news so you know what's going on with your investments. Yep. Especially now, there's always something going on in the market.
Yes.
My goodness. Yeah. Don't miss a day.
Yeah. Yeah, and I mean, with that, with the market too, you want to be informed, but make sure that if you're investing for the long term, you can't let the emotions of the news get to you, because the news, they want to keep you hooked, right? It's like that's how they get their ratings too. So,
of course. Great. Well, we learned a little bit more about what type of investments, paying down the debt, some more of the how we can build our plan for retirement. I guess, we've talked about earlier that we needed to possibly start as early as we can. So what I would like to go over is when, which means, when should we start investing? And with that, at different age. So for example, if I'm 30 or 40 or 50 plus, where should I look to invest? Because I know what I've heard and I've read before is as you're younger, you can be a little bit more riskier with your investments compared to when you're a little bit more older, where you need to, of course, maybe take a little bit less risk and find ways to do it more securely. Got it.
Yeah, that's a great question. And I would say start early. Start as early as you can. The earlier, the better, because if you start early, you don't have to take as much risk. You don't have to worry. You can invest in things that don't generate higher returns. I don't encourage that. I think you should still invest in things that are going to give you a good return on investment. When I say good return on investment, 10 to 12% is really should be your target. And there's a lot of ways to do that. We talked about some of them already. Now, if you are someone that's in your 30s and you're getting started, really you can opt to start contributing to a traditional IRA, traditional Roth IRA, or just putting it in putting that money in a mutual fund at $400 a month. You could start just accumulating that money slowly. Could you do other investments? You can do that too, but this is a good, safe way where you basically are saying, you know what, I'm going to be retired when I'm 60. I'm going to have a good, nice nest egg when I'm there, and that'll work well for you. Now, if you're 40, I would say you're a little bit behind if you don't have any investments. I think you could still put money aside into that mutual fund at $400 a month. But I think you also really need to start thinking about maybe buying some real estate, maybe a couple of rental houses, maybe couple duplexes or duplex. And even consider, can you start a business maybe in the next, with your experience that you've had, or maybe within the next 5 or 10 years, and start something small and build from there. I think the next one, if you're 50 and you haven't accumulated any retirement, I think the stock market, investing $400 a month is really, I wouldn't even put that money there. I wouldn't focus on that. I think you're way behind. I don't think you're going to be able to accumulate a good enough nest egg. I think you really need to start educating yourself on real estate, educating yourself on businesses, and seeing about ways either to focus on even commercial real estate, where you can get higher returns for your dollar, or start building some wealth by even buying single family homes and in residential real estate. If you flip a house, you can make $20,000-$30,000, depending where you're at. The market's very competitive now. But if you're 50, it's something that you can start building some wealth with single family homes. The last one is you're 60, and a 60-year-old person that hasn't accumulated any funds for retirement, I would say is, of course, you're behind more than everyone else. I think you really need to start learning about commercial real estate, evaluate what you're more comfortable with. Of course, you can still do it in residential, but I think it's going to take you longer. I would really try to focus on educating yourself on commercial real estate, retail, industrial, apartment buildings, and all it takes is maybe one good deal with that. And if you can do that, that could fund your retirement.
So I just want to say disclaimer that we didn't say 20s, and it's not because we forgot about them. So I know we started in our 20s in investments. So what can you do in your 20s as well in order for you to start building your portfolio?
Well, in your 20s and all the other age groups, you can invest in any of the things that I mentioned. What is a good thing in your 20s is that you don't really have to worry about investing in real estate if you don't want to. You don't have to worry about starting a business if you don't want to, because you can just go ahead and start an investment account that automatically sends not even $400. You could even start investing less, $250, $200, and you'll still end up getting a nice nest egg. Save as much as you can, invest as much as you can, because it's all going to pay you back later. Maybe you want to retire sooner. Maybe your goal is not 60. Maybe you want to retire at 50 or 40. So saving more and focusing on investments that have a higher rate of return help you do that faster. Yep,
I agree. All right, great information. Thank you so much for giving us those tips and advice. Now, I guess, the next question is why is this all important? I know some people, will ask that, especially our little youngins. Why are we talking about planning? Why is this important for my future? So I know, from my perspective, And why I always like to tell people is, for me, the future isn't foreseeable, number one, but also to depend on the security of social security.
Mm-hmm. The security of social security.
Yeah, exactly. Ironic. It's not guaranteed.
Mm-mm.
And we really, don't know what's going to happen in the future. So for me, I'm not someone that feels comfortable with relying on one source of income. Mm-hmm. And with that as well, maybe the amount of Social Security that you're receiving is not a lot, which is actually a problem that we do see now, mm-hmm. that we have people who are retiring and their Social Security is not enough for them to live on. Mm-hmm. So really, it's important for you to try to have other investments or other cash coming in, which will allow you to, number one, for me, is to live comfortably, where you're not having that concern. You're not worried about, having to get food or where you're going to have to live, or your health, those type of expenses. And that's really, the concern I like to try to tell people. So it doesn't take you to own 200 units. I know some people, get overwhelmed with that, or to be an expert in stocks, or you need to open up a $10 million business, right? I think it can take one property, it can take two properties that's bringing in enough $2,000 or $4,000 in additional income to your Social Security, or a small business, or maybe you have saved up some cash for you to be able to do that. It's just really important for you to start thinking of these things now so that you are prepared for that in the future.
Yeah, I think that's a very good point. Something Social Security says it. If for those of you that receive the Social Security statements, you don't receive it until you have enough credits. But once you start receiving it, it says it on there that Social Security Administration, they highly encourage you to have other investments and pensions and programs, because it may not be enough for you to retire with. And they're also going to start sending out. They're also going to start paying out more money than is coming in within a certain amount of time. So this is the data is there, the facts are there, so you should prepare yourself just in case. And something going with Social Security is healthcare. And I know that Medicare is out there for a lot of retired people, but you also sometimes it's better to have better healthcare. Medicare has options that are supplemental options that are more expensive, so you can get better coverage, and that's also costs money. So if you have more funds, you have more flexibility and more choices.
Yes, great point.
So with in closing, a couple of other things to make sure that why it's important is you don't want your funds to outlive your retirement, or your life. So you don't want to run out of money when you retire, and maybe you live until 90, but then your money ran out at 80 or 85, and then you're like, wow, what am I going to do? I have to live on Social Security. I have to live from the government. That's the worst thing when you're in your final years, that you have to completely change your lifestyle. Then financial literacy is another important thing, and this is to enjoy a comfortable retirement, so you're properly diversified, so you properly reduce risk. Sometimes I've seen a lot of retirees, they accumulate a lot of money, but then they invest in the wrong things while they're retired, and then they put their nest egg at risk. So that's something else you want to be aware of, what you're investing in, and then make sure that you're protected, right? And then you're not taking more risk than you should. One that everyone loves, look, taxes need to be paid. We live in one of the greatest countries on earth, and for that, you have to pay taxes to pay for some of those things. But you don't want to pay more taxes than you need to, because taxes eat up a lot of your funds. So you have to, by being financially educated, this allows you to pay less taxes and to generate more wealth over time. And one of my favorites is to retire sooner than 65. Why not 50? Why not 40 or younger? And anything else you want to add, Des?
No, I think those are all good. I think we're seeing a different movement where we are seeing people retiring at 30 and 40 because they are putting together strategies for investments or finding other ways to earn income. So we are seeing that a lot now, I think, with this generation, and I think it has a lot to do with technology and the access to resources. So it's definitely an opportunity and you're able to do it. So hold on to the dream.
Yeah, there you go. Anything's possible. All right, guys. So thanks for tuning in. I hope you enjoyed the call and that you have a few new tools for your wealth building toolbox. To learn more about real estate investing or how to be a capital partner, visit our website at www.everythingaboutwealth.com. See, I mentioned the website there.
Oh, there you go.
If you like the show, make sure to subscribe and like us on iTunes or your favorite app. And with that, see you on the next show. Take care. Bye-bye.